Our next speaker is Warren Pearce. Warren is the Chief Executive Officer of the Association of Mining and Exploration Companies. Warren will be providing a 15-minute address followed by 5 minutes of questions.
Okay, thanks Jenny, and thanks Bill and the Paydirt team. All right, what I'm going to talk to you today about is I'm going to firstly start by telling you the things you already know. I'm going to show some graphs that hopefully show that what you already know is actually right. And then I'm going to have a look at some of the what those graphs are telling us about the way in which the global industry is leaning and the way in which nation states are approaching our critical minerals industry. And then I'm going to tell you what Australia is going to try and do about confronting those challenges and turning things back to our advantage. So, for those of you who don't know the association, we represent over 580 companies across Australia, primarily mineral explorers in every commodity and mineral, and indeed with, of course, helping companies going into project development and those in production as well. Our major focus is on trying to reduce the cost of doing business and making sure there is a good economic framework here in Australia to support companies and investors investing in developing projects, and of course looking at opportunities to reduce the cost of doing business, to streamline red tape and of course build community support for our industry. All right, so where are we at in terms of our industry at the moment? We're coming off the back of a record period. 2023 was a record period for mineral exploration expenditure in Australia and in Western Australia, with over $2 billion expended in that period. That's some pretty exciting news. However, over the same period, essentially what we've seen is the investment for mineral explorers start to fall away, and we've been going through a period of low investment for the last sort of 12 to 18 months, which is starting to put pressure on mineral explorers being able to continue their programs. Along with that, we've seen producers under increasing cost pressures as inflation pressures hit our industry. We've seen raw material costs up to 30 or 40 and 50% increases. We're dealing with a very limited labour pool and skills pool, which is of course putting pressure on wages, all of which has added cost to our businesses. Now, through a lot of that period, our producers have been in a good commodity price environment, which meant they've been relatively able to manage those pressures, but of course that increasing price environment has put pressure on new projects coming into the market and whether they'll be viable to move forward. So we've seen capital raising been very difficult the last 12 months. We've seen IPOs almost disappear in the last 12 months, and of course developing projects in an emerging industry is always challenging. We'll talk a little about why. All right, so that's the context where we're at. It feels a little flat. There's a lot of reasons to be optimistic and a lot of reasons to believe that things are going to improve. All right, so here's the first of these graphs. This one comes from the International Energy Agency, essentially showing you what's happened in the last 10 years in terms of critical mineral demand going into batteries and energy storage. You can see that the talk about exponential growth has really been quite true, particularly over the last 5 years. We've seen extreme increases in terms of demand and also supply being brought on to bring that to meet that demand. Having a look at this one, you can get an idea about where those critical minerals are actually going. So as you'd expect, most of our critical minerals are going to China, but you can see particularly on the far right of the graph that other nations that are our critical minerals processors for the world are starting to really pick up that piece and import more of our critical minerals. So essentially, I'll come back to why this needs to be addressed in a moment. This is just a graph, it could be one of 1,000, that shows you that indeed looking forward, critical mineral demand continues to go north quite substantially, particularly to 2030. That one looks at nickel, cobalt and copper, and you've just heard Darren give you the picture about what's expected in terms of the demand need for copper over the next 15, 20 years, all of which is extraordinary. So you're probably wondering, if all these graphs are right, how come our price environment isn't much better than it is? Well, there's a few reasons for it. And certainly we've seen it play out, in particular with the lithium sector here in Western Australia, over the last half a dozen years. The reality is, although the projections are proving to be right, and indeed the trends going forward look incredibly promising, it's not a consistent level of growth. It's not simply a straight line out to 2030 and 2050. In reality, the supply chain grows at different rates. And so what happened in lithium half a dozen years ago, as the demand started to grow, Western Australia was very good at being able to turn on lithium lithium spodumene projects. We brought on a lot of supply quite quickly, and then what happened was we found that the supply chain, the next link in the supply chain, chemical processing, wasn't able to build the same capacity at the same rate, and consequently we oversupplied the market, and very quickly mines went into care and maintenance, the price fell through the floor. We had to actually work with the state government here to provide some temporary financial assistance to keep mines open. Within 12 months, that demand-supply piece had changed again. Lithium prices went through the roof, and again we went through turning mines back on, growing production and taking advantage of those opportunities. All of which is just a way of saying this is what happens in emerging industries. The supply chain grows at different rates, it's not consistent, we're going to go through some fairly wild upswings and downswings on the journey towards growth. That's not necessarily a bad thing as long as we can manage our way through the down periods. This graph here shows you where our critical minerals are processed. So what you'll have been told relentlessly over the last several years is most of the world's critical minerals are processed in China. That remains true. And that, of course, is one of the things that is driving all these global interventions to try and break this dominance of the critical mineral supply chain into batteries. So, looking at two of those sort of things, if I just jump back a bit, can I do that? I can. Why are those countries the ones importing the critical minerals? They're the ones who are going to be our customers for Western Australia and Australia's raw materials. And you can then see a little help. I'm pressing the wrong button, that's why, there we go, sorry. You can see that's the reality of what's happening. That's where the dominance of that piece is. If you look through that graph, that one's from the International Energy Agency, you'll notice the United States is not one of the countries taking up any large proportion of critical minerals processing in those spaces. You'll see from the previous graph, you're starting to get countries in the Western supply chain, so to speak, Australia, United States, Korea, Japan, South Korea, really entering into that space and starting to grow their share of processing and development of batteries. This is how the world has responded to that challenge. So we've moved from a place of strategic cooperation into strategic competition, where now nations are working very hard to separate themselves from the Chinese supply chain and to provide independence from it. And consequently, those nations have started to make major global market interventions. There's been 1,500 since 2010, and you can see the numbers massively increasing since 2017. The most well-known is the Inflation Reduction Act from the United States, which its goal is essentially to attract capital into downstream processing and supply chain manufacture for batteries into the United States. Now, yes, the IRA offers some opportunities for Australia, but it also creates some serious challenges, and we'll talk about that in a moment. Some of the slides we're going to show you come from a report we did with Mandela Partners on a proposal for production tax credit here in Australia. I'm going to talk you through some of the context of it before I talk you through the proposal we put to the Commonwealth Government and the way in which the Commonwealth Government is responding to it. Here you can see some of the key competitor states or nations in terms of what they're offering in terms of critical minerals incentives, looking in that space from concessional programs, low interest loans, direct grant funding, tax incentives and production tax credits, as well as investment tax credits. So you can see that those countries are all stepping up in multiple spaces to provide wide-ranging incentive packages to support critical minerals processing and supply chain development. But also it's important to realise a lot of those programs don't just focus on the downstream, they also offer that incentive support to critical minerals upstream, meaning mining and minerals processing. Now here in Australia, up until now, we've not been competing on the same level. So here's a little picture of our Australian political leaders, our Prime Minister, Treasurer, our Resources Minister, our Climate Change Minister and our Industry Minister, all speaking very positively about Australia's opportunity and our desire to take advantage of the critical minerals opportunity here in Australia. However, up until now, the measures we put in place support it simply don't match up to what's happening on a global scale. And what that means is we are seeing investment in downstreaming particularly, but also critical minerals projects head overseas where they can take advantage of these incentives that essentially distort the market, meaning that things that were commercially viable or would be very commercially attractive here in Australia 3 years ago now look decidedly less so when you add in the various market interventions. That said, Australia has done a number of things. We put in place the Modern Manufacturing Initiative, which was the previous coalition government. There's about $1.3 billion there. About $500 million was given in direct grants to individual projects. That was a very important investment. You've seen the new federal government come in with the Reconstruction Fund with about $1 billion allocated to value adding for resources. And then more recently, $4 billion allocated to the Critical Minerals Facility Fund, which is likely to be low interest loans. There's also a range of other Commonwealth funding pools that can make money available to critical minerals projects, largely in the low interest loan space, things like NAIF, the Northern Australian Infrastructure Fund, the CEFC, EFA and others, all of which have been an important help to getting projects moving and help them develop into operating mines. That said, when you compare them with the world-leading Inflation Reduction Act, it's very small beans indeed. The United States has put a $1 trillion package on the table to essentially try and capture the entire supply chain from chemical processing to battery manufacture into EVs. Now, one point I want to point out here is their production tax credit. Out of the $1 trillion package they put forward, about $31 billion is allocated towards their production tax credit, which is a 10% production tax credit. So 10% of your production costs are sectorally deductible for the value adding of minerals. That's a good thing. We've watched that make downstream processing in Australia look a lot less competitive, and indeed that's why AMEC, with our members, has brought a proposal to the Commonwealth Government essentially to bring one component of the Inflation Reduction Act to Australia to be implemented here. Now, it's important to recognise that Australia can't compete with a $1 trillion package. We're not on the same scale as the United States. We don't have the same ambition. That doesn't mean we can't be successful in the areas where we have comparative and competitive advantages. So we proposed this around the downstreaming of critical minerals. We brought together 11 member companies who had already been developing and doing work on value-adding proposals for their own projects, and had actually undertaken some variations of feasibility studies and had numbers that they could put together that would help us cost the impact on the Commonwealth budget, but also to look at what it might return in terms of economic value to Australia. We began those conversations over a year ago with the federal government. We looked at a range of tax incentives that have been tried in Australia before. Ultimately, the production tax credit seemed the most likely to find political support, primarily because if you don't get into production to produce a value-added product, the government doesn't have to pay the credit. So essentially, it means the money the Commonwealth allocates guarantees it will be spent if there is a successful proponent. It also changes the commercial prospects for the project and makes us 10% more competitive overnight if introduced. This has a look at what a targeted policy response actually would mean in terms of the IRA. In essence, we did a huge amount of work to find out if you compare Australia with the United States' 10% production tax credit and you add in a 10% production tax credit to Australia, it comes out about the same. You have to do a lot of work to get there, I promise you, but pretty much what you think happens actually does. It does have the same effect of equalising us, at least in that degree, with the United States. So we think that's an important piece, and we've been talking to the Commonwealth Government since November last year and developing that proposal with Treasury. We're hopeful there'll be some good news in that space in the next couple of months. Now, this is the piece I want to concentrate on, which is new news. Hopefully you've all seen last week the Prime Minister of Australia gave a keynote speech in Queensland introducing the Commonwealth Government's approach, or our effort to address the IRA and other global interventions into critical minerals, but also the broader manufacturing market into renewable technologies and other value-adding projects. What they've called that as a future made in Australia. Exactly what that looks like isn't yet known. We're going to have to wait to see what's announced in the May budget and also announcements made up until the election in 2025. And although there's not much known, what is known is they're going to try and pull a whole package of incentives together under the Future Made in Australia Act, which will be introduced to Parliament shortly. And of course, we've seen some major announcements already, including investment into the Hunter Valley Solar Farm and assembly of solar panels in New South Wales. So the Commonwealth made it quite clear that areas they're likely to get involved into: renewable energy technologies, critical minerals, battery storage, energy storage, all of areas that are going to be areas of focus, but we're yet to see exactly what that's going to look like. However, it is immensely encouraging. We've been pushing the Commonwealth for now on 2 years since the introduction of the IRA to recognise that the playing field for Australia has massively changed. 5 or 6 years ago, we were, broadly speaking, competitive for some of these investments. However, our strong industry meant we've been able to attract a lot of that investment to come to Australia. So the reason you're seeing 4 lithium hydroxide facilities being built in Western Australia, those investments were made pre-IRA. If those decisions were being made again, they would probably be made in America. So we need to respond if we're going to take advantage of these opportunities. Beyond that, all I've really said so far is there's some principles the government will try to follow. They'll be guided by the idea to act and invest on scale, which is essentially a desire to do things at a large scale, to reap economies of scale and cost efficiencies. Exactly what that looks like and how big the federal government's prepared to play in this space, we're yet to see. They want to capitalise on our comparative advantages and on building sovereign capability. So again, that speaks both to areas where we've already got considerable strength. Those who read The Australian might have seen that the mining industry per capita, the mining industry per hour, I think, is the highest value-added industry in Australia, which I think would surprise many, but it's actually true. And indeed, finally, they're looking to invest in those areas where we're already strong or already believe we have considerable strength. So looking to how that's going to roll out, I expect we'll see more announcements the next couple of weeks in the lead up to budget. Hopefully we'll see a production tax credit or something like that made available to critical minerals, and indeed beyond that, we need to continue as Australia to make our jurisdiction more competitive by reducing red tape, driving down costs and finding ways to help our members attract international investment in Australia to deliver these projects. Thanks very much. I'm happy to take your questions.